Hello, everyone. I am Kevin Ramirez with AAA Mortgage Training, and I'm an NMLS instructor that offers the official NMLS pre-licensing 20-hour course, which is a required course to become a licensed loan officer in the mortgage industry. So I'll tell you one of the things that I pride myself in, though, if you've been watching the series, is I have a live webinar. I'm pretty energetic over the webcam. I like to have fun with you while I'm teaching you to properly prepare you for the NMLS test a little bit better than some of the self-paced competitors out there. So let me share my screen and welcome to part 4 of the series. Hello, everyone. I am Kevin Ramirez, NMLS instructor with AAA Mortgage Training. I offer the official NMLS pre-licensing 20-hour course. The course is required to become a licensed loan officer in the mortgage industry. I've been doing this for many years, and I just want to give you a little taste of my live webinar experience, so you can see the difference of someone teaching you and explaining to you in detail with a little extra personality, a little bit better than some of the self-paced courses out there. So let me share my screen and we'll get started with part 4 of our series. So today we're going to look at second mortgages, the common term, but a better term might be subordinate mortgages, subordinate home loans. What does that mean? We'll start off with some terminology. Moving this over for you. Well, secondary financing is typically used to assist with a purchase down payment to avoid private mortgage insurance, PMI, which is my class we would have talked about already. So again, why would you get a second mortgage? Well, there's many reasons, but one of them, a common reason to buy a home is, well, I could do one loan and have private mortgage insurance at a high loan to value, or I could avoid the private mortgage insurance and get two loans. So two separate loans with two separate payments, but again, because I don't have a big enough down payment to avoid private mortgage insurance. So I could do one loan with that, or I could do two loans. Or a second mortgage can also be obtained for cash out on a refinance. So later on, you already own your home. Now you want to try to get cash equity out of your property for whatever reason, home improvement, this or that. Well, it's another reason you might get a second mortgage. Okay. So just giving a reason of why you might do so. Now, a term you should know, it's called a piggyback. Common term there. If it's not intuitive, what's a piggyback? Well, this is a second mortgage for a refinance or a purchase that funds, as we talked about in our class, funding, settlement, closing. It funds at the same time as the first mortgage on the property. So basically, you get them at the same time. You get a first mortgage, you get a second mortgage at the exact same time. So that second mortgage is called a piggyback because, as you would guess, it's piggybacking on the first mortgage. Okay, simple term there. So stay with me though. Some folks get confused here. We have another term that's important to know, such as a purchase money second. So what is this term? Well, in simple terms, it's a piggyback. We just define what a piggyback is, right? A second mortgage that funds at the same time as a first mortgage. However, it's a purchase loan when the transaction is for a purchase. If this second mortgage funds at the same time as the first mortgage, a piggyback we just said, when purchasing a property, you would write in purchasing here to help with the down payment. Again, we just talked about why you might get a second loan. You could get one loan with PMI or a second loan to avoid the PMI. Again, this is to help out with the down payment. Now, why even have a special name? You're like, Kevin, a piggyback's a refinance or a purchase loan that funds at the same time as a first mortgage, right? Got it. So why is it purchase money second? Why do you have a special name for it? Well, I'll clue you into something that actually may not be on the test, but this is a little extra flavor I give you in my class because I'm trying to set you up to be a successful loan officer, not just pass the test. So, for instance, an experienced loan officer like myself would know this, and as someone new to the industry may not. This is where the competition really plays out when trying to help customers. Well, we would have learned this already in the class, but if I'm just doing, I ask the customer, hey, you know what, sir, what would you like to do for this refinance? Well, I have two loans that I would like to combine into one loan. Okay, we do this quite often, sir. So my next question to the customer is, did you get those two loans that you're trying to combine together at the same time on that property? Yes, I did. Okay, great. Piggyback. We just defined that. Next up, by the way, when you got those two loans at the same time, was that to purchase the property? Yes, it was. Fantastic. we're going to call that second mortgage a purchase money second. The borrower could care less about this, but why they do care is because when I do a refinance and I consolidate those two loans together, that first and purchase money second, that is called a rate and term refinance on a conventional conforming loan. So this is fantastic because it gives you better pricing, better guidelines. Versus if I didn't know this and a customer says, oh, I want to go ahead and refinance my first and second, and I didn't know the rule I just said, some loan officers would call that a refinance cash out, and that has higher pricing, stricter guidelines. Think who's going to win when two competitors are trying to fight for the same customer. So to go a little step further, by the way, if I ask the customer, hey, by the way, when you got those two loans, was it the same time? Yes. Was it for a purchase? No. Oh, so you got those two loans, the second's a piggyback from a refinance. I could combine them together, sir, but just be aware this transaction will be labeled a refinance cash out. So that's how it works. That's why it's important to know these things and why there's a special name called purchase money second. The little tip of the trick may not even be on your test, but like I said, I do care that you should know these things going into this industry so you're not at a disadvantage when you start selling loans. So I have an example right here. What's an 80-15-5? What does this mean? Well, I think many people heard before the term many years ago, before 2008, we used to do 80-20. A first mortgage up to 80% loan to value, and the second mortgage 20% of the value, right? So 80-20 is 100% financing. Is what we used to do. We don't like doing that so much. If you watch part 3 of my series, you saw that usually the customer has to have at least 5% of their own money, typically, right? So what's it, 80-15-5? What's like this? Sir, all right, whatever you want to do, a $200,000 purchase, great. I can give you a first loan up to 80% loan to value at 160. Now, why is it stopping at 80%? If you watch my part 3 of this series on YouTube, you'll remember that if I cross 80%, 80.01, once I go right above 80% loan to value, it's a riskier loan. That single loan will have private mortgage insurance, PMI. So we stop the first at 80 to avoid the PMI, and then the remaining down, or what he doesn't have with the down payment, we lend them a second mortgage, a whole separate loan with a separate payment for the next 15%. So that's the 30,000. So we have a first and second, right, for combined loan to value of 95%, 80 plus 15, right? So the LTV is 80, the CLTV, combined loan to value, is 95, and the rest the customer does have to come up with their own money, and that is 5% down payment of their own money. So that is a 80-15-5. I'll go a little step further for you before on this teaser. Next page. So, by the way, people always wonder, well, what makes a first mortgage, second mortgage? How do you decide? Is it the big one's the first one, the small one's the second one? Well, to some degree, yes, but that is not an exact answer. It's customary that the first loan is bigger than the second loan. But really, what it comes down to is whichever lien, home loan, is recorded on that property with the county public records first takes first position. First come, first serve is really how it comes down to. So it's whatever lien is recorded first takes first position. And why is that important? Because the first position lender gets paid first in the event of a foreclosure sale, is what you would write there for the answer as you're taking my class. Now, this is very important as I'm a first mortgage holder lender or a second mortgage holder lender, right? Let's take a look at this example here. Let's say, of course, it's only on the same property. If it's two different properties, that's a whole different thing. We're talking on the same property. The first mortgage for $200,000, and the guy on that same property has a second mortgage for $40,000. Altogether, he has $240,000 in total liens on that same property. No big deal. Well, if things go bad and we have to do the foreclosure sale and the lender takes the property and sells it on a public auction just because the lender's just trying to get their money back. Well, in the event of this foreclosure sale, if the lender sells the property for $210, so we didn't quite get the sale to cover the $240,000 that is owed between the first and second mortgage, which could be to two different lenders. The first mortgage could be one lender, second mortgage could be a completely different lender. Doesn't have to be, but they can be different lenders. Okay, so if they sell for $210, the first mortgage receives full satisfaction. They get paid first. They'll get paid the full $200,000, and the second mortgage is only paid the scraps, what's left over, only $10,000 because we sold it for $210. So that full $40,000 is not paid in full. That second mortgage would receive a loss of $30,000. That's the risk of being in second lien position. So you see, second mortgages, junior, subordinate mortgages, they are riskier. They're second to get paid off. Sometimes in 2008, when everyone was doing short sales and foreclosures, second mortgages were not getting anything. First mortgages were barely getting some of their amount. Second mortgages weren't getting anything. That's a tough place to be in. So again, why second mortgage rates tend to be higher, also because the loan amounts are typically smaller, which, to make interest and profit off of that, the rates have to be a little higher to offset that. But one thing to know about this, tax liens, good old government tax liens. Well, the government likes to get their money first, so they will take priority lien position, first lien position, over all loans on that property, regardless of when recording. So that's important to know. You have a first mortgage, second mortgage, then the customer gets a tax lien on that property for whatever reason. That goes right into first position, which is why us as lenders, especially most lenders that you're going to work for, offer first mortgages. Some lenders offer second mortgages as well, not all. But if the customer has an existing tax lien attached to them with the property and such, that's a problem. We're going to say, sorry, sir or ma'am, you need to either have proof that it has been paid and satisfied, or we're going to have to pay it off through our loan. Again, some customers don't want to do so, but it is a fact that that will have to happen. So again, why? Because we don't want a tax lien in first position. We want to be in first position as a first mortgage holder. So not going to talk about subordination agreement. I'll save that for my class. So check out the chat, guys. In the chat, I'll have a link on how to register for my class, and look out for the next. This is part 4, so I'll have parts 5, 6, and 7 teaser for my class. Hopefully you like what you see. I'm Kevin Ramirez with AAA Mortgage Training. See you soon.